Hello and welcome to TA for Traders. It is Monday the 6th of November. In this video we'll be looking at the charts on the gold price, which on TradingView has the code XAUUSD. What we'll see is that the gold price is coming back to the support of the 200-day moving average. That also represents the 61.8% Fibonacci retracement level. However, to me, gold still looks vulnerable. Let's look at those charts. And here we are looking at the weekly. So each bar represents 1 week's trade. And you can see that on this weekly we've pulled back below the rising 20-week moving average. Now that did give support for 4 weeks, and then we've fallen below it. Obviously, as we are below it, there's a chance that that will start to roll over. Once it rolls over, it will become resistance and will be a negative influence on this weekly chart. So ideally, if we're going to continue any upward move, you need to get back above that to give it, and then it will give a push up as long as it's moving upwards. To the downside, you can see that the 50 and the 200 are still moving up, and they will give support, although they are quite a long way lower, with the 50-week at 1246.9. Momentum, you can see that the upside momentum that we experienced in July and August has completely been lost. We're in a downtrend on the RSI, and it's presently at 49.16, so below 50. And on the MACD as well, you can see the longer term is above the short term. They're both moving down, still above zero, but indicative of negative momentum. And on the daily, so here each candle represents 1 day. You can see that the 20-day has been acting as resistance on any rally. It's still moving down. Above there's also resistance from the 50, which is now rolled down as well. But to the downside, there is support coming in from the 200-day, which is at 1262.2. I'd say that's quite a key support level. I won't show you on the chart, but it's the Fibonacci retracement. If you do a Fibonacci from the low on the 10th of July and the high on the 8th of September, the 61.8% is just above that 200-day. So it is a level that people will be looking at. Momentum is drifting to the downside. The RSI is 43.12, so below 50. You can see it's just flat lining at that level. No real attempt for any rally on the RSI, and likewise the MACD are flat lining but below zero, so would be vulnerable to any move towards that support at the 200-day. And looking at the 4-hourly, so here each candle represents 4 hours of trade. You can see that we've had a rally for the last 3 bars, which is positive, but it's only going to take us towards the resistance of these moving averages. The 50 moving down, that's 1273.51, and is the first resistance level. Above there, the 20 is actually going sideways, but will continue down on any downtick. RSI, although it has picked up recently, not a significant rally, it's still below 50, 46.48, and the MACD as well are still vulnerable as they're below zero, short term below longer term, indicative of negative momentum. Looking at the support and resistance levels, the resistance from the 20 days at 1281.26, Above there, the high of the 20th of October, 1291 spot 22, with supports coming in at 1263.58, 27th of October's low, and then the 200-day 1261.8. So that's been TA for traders looking at the gold price. The conclusions from the video should be that we're back to support at the 200-day. It's also the 61.8 Fibonacci retracement level. However, negative momentum is dominant. The 4-hour needs to break above those moving averages to pick up any upside momentum. And in conclusion, I believe that gold still looks vulnerable. Thanks for watching this video. If it's the first video you've seen from TA for Traders, please do subscribe. You then get email updates when I come out with other videos. I don't just cover commodities, I cover the FX, equity indices, and I come out with videos on single stocks in the UK and the US. Thanks for watching. These videos are for information only and for educational purposes, and they're not meant as an investment recommendation. Please do read the disclaimer.